Giles Keating is Global Head of Research for Private Banking and Asset Management at Credit Suisse. He says that in the short term, you need to be overweight cash and short maturity, good quality bonds. He says take risk off the table. That means shifting away from equities, credit and commodities and being defensive by sector and region. Well, Giles joins us now from the bank's London headquarters. And so, Giles, we'll talk about your long-term views in a moment, but just explain what we've just described here, your short-term strategy.
I think it all depends on the risk profile of investors, and we're certainly saying that investors who are more at the risk-averse end of the spectrum should just be looking to reduce risk, even at the current reduced levels of many asset prices, simply because this volatility does not look as though it's going to go away for some time. Of course, in a longer-term sense, we think there is a lot of value out there in a lot of areas. But in terms of what we want to see the policymakers do, we're maybe about halfway through our shopping list. And until we get a lot closer to the end of that, I don't think we can see that value being realised.
And, you know, Giles, I have to say, a lot of people I speak to, they say pretty much the same thing. And that seems to be the big problem right now, is this total lack of clarity. And that seems to make it very difficult for investors to perhaps distinguish those companies which are in a genuinely strong position from those that might be in trouble.
Well, I think there are obviously a number of metrics that you can look at, whether you're looking at cash holdings, earnings cover for dividends, all the usual and obvious metrics. And I think certainly we can identify really quite large numbers of companies that we feel pretty comfortable with. That's not the same as saying they can't go through more dips in the near term. In these kind of markets, you sometimes get the best assets being liquidated because an investor is in trouble somewhere else in their portfolio.
And I suppose that's precisely the problem. How difficult is it to identify, even if you are finding companies that you're comfortable with right now, how confident can you be that they would withstand the shock of another recession if it happened?
Well, as I say, you can look to the kind of metrics in terms of cash, in terms of where the markets are. Certainly I think there are a number of companies you can feel still relatively comfortable with, at least in some longer term sense. And of course, let's be clear about it, a normal recession is now priced in to equity markets. Certainly we feel that markets are now discounting something like the 30% earnings decline that would be normal in a recession. You'd have to get something much deeper than a normal recession in order to require equity prices in valuation terms to be lower than they are now.
OK, so they're already pricing in a recession. Giles, I want to talk a little bit more about your longer-term view, because I know that you remain optimistic in the long term, expecting a conclusion to be reached on Greece by the end of this year, with a breakup of the euro only a dramatic possibility, you say. You are forecasting a mild recession with a surprisingly good rebound. So tell me, what's behind your optimism?
I think if you look at the cash position of companies, if you look at the notion that we are, as I say, already quite a long way through the policy measures that are needed to stabilise things here. Of course, there are still some unfilled boxes. We need to have some kind of resolution on Greece, and that, of course, can take various forms. We need some more recapitalisation of banks, although, of course, last night we saw the beginnings of a move towards recapitalisation of some of the smaller European banks. And we need to have the EFSF approved by the national governments in Europe. So there's still quite a lot that has to be done, but we are still a long way down that road. And we think that we will see those policy measures dropping into place. And for that reason, I don't think even a mild recession is by any means assured. But I certainly think the risk of a very deep recession is extremely small.
And interestingly, Giles, you do say that it's important to distinguish between different banks. Now, do you think that is the case, even when we still have this cloud of uncertainty over the banks in terms of the tighter funding markets and the possibility of further recapitalization? Even with these risks in place, you're saying, actually, there might be some good opportunities out there.
I think in the banking sector, as in stock markets and indeed debt markets generally, there has been a bit of a tendency for all ships to sink more or less regardless of their underlying position. And I think that certainly has created value. I think in terms of certainly the senior debt issued by a number of the stronger quality banks, I think investors can already be looking to take advantage there. Many of those spreads are, at least on the senior debt side, are more or less as wide as at the depths of the 2008 crisis.
Giles, how much does it reassure you that central banks are willing to step in and offer dollar funding to European banks that might not be able to access it so easily? Is that something that reassures you when it comes to thinking about the banks in terms of investment, or do you think that is just a short-term solution, a temporary sort of solution to a liquidity problem when actually what we have is insolvency?
Well, of course, we've seen the ECB offering euro funding all along. We've now got in place this new announcement of dollar funding specifically designed to cross the potentially difficult year-end period. I think all of these things are very reassuring, all the more so because, of course, it was the problems in short-term funding that so much exacerbated problems after the Lehman shock. So at least one of the adverse transmission mechanisms that caused all the trouble after Lehman's appears to have been dealt with ahead of any problems that might be coming forward to hit us. So that I do find reassuring. Of course, in the longer term, weaker banks need to be recapitalized and confidence needs to return in the stronger banks that have already got the capital that they need. Yeah. And so in that sense, what the ECB is doing is only temporary, but it's a very important temporary measure.
Thanks again for joining us. Giles Keating, Head of Research for Private Banking and Asset Management, Credit Suisse.